Opendoor is heading into Monday's pre-market trading holding relatively steady. After the wild ride we saw post-earnings, with that massive sell-off, the bounce on Friday, and now a calmer start to the new week, it's fair to say that the tone around this stock has shifted, at least for now, from pure volatility to something more measured. And for investors who have been looking for a moment to take stock, no pun intended, this might be the perfect time to reassess where things stand. One of the biggest pieces of news is that Opendoor has secured compliance with Nasdaq's minimum bid price requirement, and in doing so, it's now cancelled the planned reverse stock split. That's a huge relief for a lot of retail investors. Reverse splits can be controversial. In some cases, they're simply a cosmetic move to meet listing requirements, but they can also signal deeper issues that spook the market. By avoiding that move, Opendoor has sent a message that, for now, the worst-case scenario of delisting is off the table. That alone takes a major overhang off the stock. The company had been planning a shareholder meeting to vote on potential reverse split proposals, but that meeting is now off the calendar. From an investor confidence perspective, that's about as clear a signal as you can get that the company believes it can keep the share price above the threshold without resorting to mechanical fixes. It also means management can focus energy and resources on operational execution rather than technical compliance. For a business in a sector as challenging as real estate right now, that's important. Alongside that compliance news, Opendoor has been talking more about its strategic pivot toward agent-led transactions. This might sound like a subtle shift, but it's actually quite meaningful. Opendoor built its brand on the idea of buying homes directly from sellers, simplifying the transaction, and then reselling them. It's a capital-intensive model, and in a high-interest rate environment, the cost of holding that inventory can really squeeze margins. By leaning more into partnerships with real estate agents, Opendoor is opening up a more capital-light revenue stream. It can still benefit from its tech platform and brand recognition without tying up as much money in home purchases. That shift is part of what gives me a cautiously bullish tone on the stock right now. It shows a willingness to adapt, to meet the market where it's at rather than stubbornly sticking to the original playbook. The real estate market is seasonal, it's cyclical, and it's highly sensitive to macro factors like interest rates. If you can adjust your business model to keep revenue flowing during the tougher parts of that cycle, you stand a much better chance of not just surviving, but building a base for future growth. And let's be honest, the macro picture is where a lot of the bullish hope is coming from right now. There's growing expectation that the Federal Reserve will cut interest rates as early as September. JP Morgan is now among those forecasting a cut next month, and that's in line with the narrative we've been talking about for weeks. Weak jobs data is giving the Fed cover to ease policy sooner rather than later. For Opendoor, that's about as direct a catalyst as you can get. Lower rates make mortgages more affordable, stimulate housing demand, and can loosen up transaction volumes. In other words, it addresses one of the biggest constraints they've been dealing with, the inability to buy and sell enough homes to hit the kind of revenue numbers they've achieved in better market conditions. If rates do start to come down, it doesn't just mean Q3 could come in stronger than expected. It could set up Q4 to be meaningfully better, given the seasonal pickup in housing activity toward the end of the year. Of course, rate cuts aren't guaranteed. The Fed could decide to wait for more data, or inflation could surprise on the upside again. That's why I measured here. I don't want to paint a picture of inevitability. But the probability of a September cut has been climbing, and the market is already starting to price that in. Looking at Friday's action, we saw Opendoor close at $1.95 a share, up 5% on the day. That bounce came after some very rough trading in the wake of the Q2 earnings release, when the stock was punished hard for what many saw as a soft outlook for the back half of the year. But as we've been saying, part of that outlook is simply seasonal. Real estate transactions slow down in Q4 almost every year, and in a high-rate environment, that seasonal dip looks even more pronounced. It's important to separate that natural seasonality from structural weakness. The media coverage in the immediate aftermath of earnings didn't really make that distinction, and I think that's part of why we saw such an exaggerated reaction. Now that some of that knee-jerk selling pressure has washed out, the stock seems to be finding a more stable footing. The fact that it's holding steady pre-market on Monday tells me that investors are taking a breath and reassessing. That doesn't mean we won't see more volatility. This is Opendoor we're talking about, but the selling frenzy seems to have cooled for now. There's also the sentiment factor to consider. We've seen figures like Eric Jackson publicly advocate for the company in recent days, even while being critical of current management. That's important because it shows there are still influential voices in the market who believe in the underlying value here, even if they want to see changes at the leadership level. And the open letter from retail shareholders that Jackson amplified on social media really crystallized some of the frustrations. Lack of insider buying, vague earnings calls, a sense that management hasn't been fully transparent, but it also underscored the fact that long-term holders still see potential in the brand and the technology. That combination of frustration and belief can actually be a powerful driver if it leads to constructive changes. In terms of scenarios for the short term, I see a few possible paths. If the market continues to lean into the idea of a September rate cut, we could see a gradual bid under the stock as traders position for improved Q3 and Q4 results. If management provides any sort of update or additional color that reinforces their strategic pivot and operational discipline, that could accelerate the move. On the flip side, if macro data between now and the Fed meeting in September comes in hotter than expected, that could dampen rate cut hopes and put some pressure back on the stock. But even in that less favorable scenario, the elimination of the reverse split overhang and the ongoing shift toward a more capital-light model should provide some degree of downside cushion. So, where does that leave us heading into this week? For me, it's about watching the macro data, keeping an ear out for any further communication from management, and seeing whether this newfound stability in the share price can hold. The bullish case is straightforward. Macro conditions are about to turn in your favor, your business model is adapting to the current market, and the worst regulatory overhang has been lifted. The measured part of that view is acknowledging that the housing market is still challenging, that execution on the new strategy matters, and that one or two good days in the stock don't make a trend. For long-term investors, this could be a moment to quietly accumulate, taking advantage of a calmer tape before any potential rate cut rally kicks in. For traders, it might be about watching for confirmation that $1.95 can act as a base, or looking for a breakout above the post-earnings bounce levels. Either way, the story heading into Monday is less about fear and more about possibility, and in a stock that's been defined by sharp swings in sentiment, that shift alone is worth noting.